beeping.
I show a record
So
button.
it's, yeah, mine showing record also.
Hey, everybody, it's Howard. I'm here with my good friends Don Nitti and Jonathan Krinsky. Jonathan Krinsky's been in his basement. He's on a hunger strike. His family's throwing him a Babe Ruth bar once a day. And then there's Nitti, who in his spare time gets tattoos. And both these guys love the market. We're coming into the fourth quarter. There's chaos at the door, potentially. And quickly to introduce everybody, Krinsky is a analyst at, what's the name of the firm?
Crest Partners.
And Crest, but what's Crest focus on?
So we're an institutional broker dealer. Kind of start off as a floor broker on the NYSE, and kind of expanded to the interdealer broker market. So we do a lot of bank-to-bank derivatives business, and then we also are a broker for the buy side for hedge funds and different institutional investors, and that's kind of where I focus on the bulk of my time, but also do talk to some of the other sell side bank desks out there as well.
But you can work from there. You focus on technical, right? You're a trained technician.
I'm the firm's chief market technician. I've been doing that for about a little over 10 years, and so I'm looking at charts all day, and happy to get into some.
All right, and then Nitty's the opposite. He hasn't. He just loves. There's some people that just. I love stocks just because I've done it, but I can go away from it for an hour. Nitti can't. Nitty's always connected.
It's very hard.
It's very hard for you to get away from the markets. You just love talking about the market. And you are at Sender, which has been a great hedge fund this year. Tell quickly about Sender.
Yeah, long short equity fund. Focused mostly on U.S. stocks. Our hedging positions we do through futures, so either Nasdaqs or S&Ps. Outside of that, we'll also trade, bonds, metals, crude as well. More volatility focused, have long-term fundamental views on certain positions. And what essentially we try to do is pick apart the market and where we see kind of the rotation happening, where the leadership is, occurring in the market. Pick really good stories that we're able to build a longer term view around in the market, and then, trade around positions accordingly.
All right, so we love talking about stocks. So you guys are nice enough to come on. Krinsky is like one of my favorite technicians. Nitti, I call a major kind of, we're on and off. Like you're busy. I call you once in a while when the markets seem interesting. But you're very temperamental.
So that's why I didn't.
You're a very hot, cold guy. You're like,
3 years.
Something you call me. But Krinsky's like fucking Matt. You introduced me to Krinsky. We golf. He's also a great golfer and a really good golfer. And I've only played with him once, but it was like he's like Bada. And so when you're not locked in the basement, Krinsky, and you're playing golf, what is it? First of all, quickly before we get into the market, what is it about golf that like criminal CEO bankers like, and also regular guys like us? What is it about golf that you think is such amongst like traders and entrepreneurs? Why is it so popular?
Well, first of all, it's good outlet. It's fun. I think if we're getting into the dynamics of it, there's a lot of counterintuitiveness in both. I think in golf you have to do a lot of things opposite to what would be common sense. You hit down to make the ball go up, you swing right to make it go left. And there's a lot of that in trading, but I think more than anything, and during COVID, it's taught us it's just a great outlet. You can actually get out. It's a natural social distance activity. As you said, I'm locked in this basement during the trading day, so it's nice to get out, get some sun.
And you took it up late, Nitti, but you got the bug.
Yeah. Well, I started when I was younger and never really focused that much time on it. And then I guess, mid-20s is when I really got into it. And then when I joined my first club, that's when I really, start taking lessons or playing more. And then you kind of put the pieces of the puzzle together. And then you play with someone like you after yeah, I think I took 2 years straight of lessons and played with you, and you wiped the floor clean with me after about 7 holes.
Yeah, now I'm trying to actually play the game. So before I was taught like in a different two-dimensional world. And I think learning in two-dimension, I think we can see why the markets, first of all, love YouTube. I mean, why YouTube is like one of the great companies of all time, and video, you know, with TikTok and whatever. Learning in a three-dimensional world is like 1,000 times easier than the way we learned in a magazine and via, you know, imitation in a two-dimensional world. To be able to see your own swing on your iPhone is like 1,000 times easier
Sick.
to frame context of how good or bad, like what you have to work on. And if I had that when I was 12, I really think I'd be, or, you know, 8. There's no way I wouldn't have been a scratch golfer. Like this summer, just using video to understand what my swing looks like from a three-dimensional helps you cement things that you're learning. And it's really a sick, fucking, unbelievable world, from trading to golf to anything.
I mean, even the amount of information, like, you know, before, I guess, even, yeah, go back like, you know, 8, 10 years ago when I really started focusing on it. I mean, you'd have to go, you get a lesson. There was some, you know, they would get some videography, but, you know, now it's like if I have an issue with my swing, dude, I just go on Instagram, I pull up Mike Bender's account and figure out 4 drills that are going to fix it in 10 minutes.
Yeah, fascinating.
Yeah.
So, and do you, Krinsky, because you're good, do you even look at that stuff, or you just like, how does? No, I mean, like,
Oh, look at my swing.
No, do you look at your own swing, or do you look at other swings on? And Instagram really is fucking amazing. Once they know you're into golf, Nitti, like all I get is golf.
It's
I get
crazy.
Paulina Gretzky in golf. So.
Yeah, I do, not as much as I should. To be honest, I haven't been I haven't practiced really much at all this year. If I get out, I just play. But no, it's a great. You're absolutely right. It's a great tool to have. And the other interesting thing between golf and markets, you know, you can't perfect them, right? There's no, you know, bowling, you can have a perfect game. Baseball, you can throw a perfect game. I guess you could, you know, you could shoot a 52 or whatever. But for most of us,
hit the ball the best you ever hit and shoot 74 because you didn't make a putt or you 3-putt.
Right.
Yeah.
So it's really fascinating. All right, to the markets. It's September. Elections coming up. We've seen, like, Nitti, I've had this question for all week when we started hearing that Massa was buying futures. How does that story break? And it feels like after the fact, and like, who leaked it, and does it really matter? So it's like 10 questions. Give me like the hot take there.
I mean, you know, it came out last week. The FT leaked it. You know, and then there was a lot of questions around it. You know, were they short stocks and using it as a hedging position? And then there was an article out tonight that they profited $4 billion from it. You know, and then the more that I've kind of dug into this over the past few hours here, it's funny. I was speaking to someone on a Hong Kong sell side desk, and they're like, "Oh, it's kind of been known for a little bit if you really dumped into the you know, the SoftBank filings, and then if you look at some of the hires that SoftBank's, you know, made over the past year, you know, their new head trader and this and that, you know, it showed that they were kind of going to be, you know, from the VC model into transitioning into a trading model on this and that. I don't think anybody has real clarity on, you know, what the fuck actually happened. I mean, but every day, you know, the one thing that I can tell you is, you know, you just have to watch the tape, right? I mean, you saw what was going on.
It was pretty weird. Like, for the whole month, right? Every day was up.
Yeah, and I mean, you know, historically going into August, people were like, well, August isn't, you know, that great of a month. If you look at, you know, Bespoke does some great reports, and, you know, Krinsky puts out a lot of great stuff also. But if you kind of look at the stats, you're like, all right, you know, people had this mindset after, you know, big run up in, you know, a lot of guys you spoke to, you know, were like, oh, well, you know, we're beginning a new quarter and kind of what's July going to look like. And then it's like, oh, you're getting, you know, low volatility in August, people are going on vacation. And then you had these first 2 days in September that it seemed like it was game on still. And then, you know, in 2 days, I mean, it was just a total wipeout, right? I mean, you get 10% to the downside. It was just full panic. But going into it, I mean, you saw a lot of it was, you know, we talked about it on the podcast a little bit, the weekly option stuff. I mean, some of these contracts that were being put up, and you looked and thought about it, and like you even said, you know, I think we were on the phone, you know, post it, and you were just like, dude, I'm buying one contract of like there was so much, so much bigger behind this that it was just, and now, you know, it's kind of unraveled itself where everyone's saying that it's SoftBank, and, you know, kind of how did they do it and this and that and how much capital. I mean, you saw it going up, dude. I mean, it was just complete insanity and lawlessness.
So, and Krinsky, what has surprised you the most from the bottom in March? I mean, so we had, you know, the VIX was at 90. I said if someone had just laid out 1,000 scenarios with this one being the one that actually happened, and he rolled the tape today, there's not one scenario in 1,000 where I predicted this. Did there anything that could have suggested this technically, other than, you know, some sort of major bottom in March?
Well, so here's what threw us off, and it may make sense certainly to you in hindsight. So coming into January, February, we actually had a similar thing going on. If you remember, that Tesla was just on a rampage.
It went to 1,100. Went to 11.
Yeah, and it was the same type of thing. Like people were just, you know, retail traders were just crushing it on the calls, and there was talk at that point of kind of this gamma loop where traders would buy calls, dealers would have to buy stock, and it was kind of the self-fulfilling prophecy. And that kind of coincided with the Nasdaq 100 itself really outperforming. I mean, really, if you recall, in January, February, the Nasdaq 100 was the only major index to make a new high. You know, Russell wasn't even close. So typically what you see in bear markets is there's usually a culprit, right? A relative underperformer, and there's a leader. The relative underperformer will kind of lead to the downside, but then by the end of the bear market, eventually everything catches up, and even the best of the best get hit. Now you could say that happened in March, but the Nasdaq continued to outperform. Yeah. It was outperforming going in, it outperformed on the way down, and the outperformance accelerated on the way out. Yeah. And, you know, that makes sense fundamentally. There's some changes from COVID that are helping the companies that had already been doing well, and it hurt the companies that were already doing poorly. So that makes sense to some extent. But I think the extremes that we now see are, if you take a step back and look at market history, and I'll give you one example. So at the peak, just before we topped out last week, the Nasdaq 100 was 33% above its 200-day moving average.
Right, I saw you post that, and you don't post that much, and I was like,
yeah.
And that was just a trade I had to make. That was just a trade.
So, right, so let's think about it. The Nasdaq 100 has been around since 1985, so 35 years. With the exception of 1999 and 2000, that's as wide as the spread has ever gotten. It's gotten close or maybe right around there a couple times, but that's about it. So there's two ways of looking at it. The first way is, well, it got much crazier in 2000. It went to 60%. Mm-hmm. But if the peak in 2000 is your barometer, you know, I think before this period, people would say we would never see anything like that again in our lifetimes. It was so crazy. And I get the fundamental picture was a lot different. The Fed was different. Everything's always different. But just for perspective, we've never seen a spread like this to its 200-day. So that's one thing. Then you combine the fact we've now been 102 trading days above the 50-day moving average on the NDX. That's only happened 7 other times in history. A streak of that long, right? So it's unusual to get this far above the 200-day. It's also unusual to be this steady in the sense that you've never broken below the 50-day during that stretch. Mm-hmm. So the only streaks longer, we saw one in 95, which obviously meant nothing to the advance. We continued to absolutely go gangbusters into the late 90s. But we did also see one end in April of 2000. So it ended the dot-com bubble. Okay. So it really doesn't tell us whether we're at a major inflection point or not. It just tells us that the clock is ticking, and we really are getting a bit stretched on even a shorter term time frame as far as, you know, how far we are from the 50-day. So,
well, I think it actually does mark inflection point. 95, it meant like we were going into jihad mode, you know, buy the dip to the upside for 4 more years, 5 more years, or something big was coming. And I don't know which ones, or 2000, which was like the top. You know, if I was going to pick, I hate to say it, I'd pick the 95. We're more like 95 on these dips because these companies have major earnings, rates are at 0. The government, passive investing and the markets have been politicized. It's hot potato, right? Biden's not going to do anything crazy either. These guys all want to get elected once they're in, if he wins. I mean, if Trump wins, the hell knows what's going to happen.
I mean, you have the infinite Fed put, right? I mean, that's
the very big Fed put. So I think I think it is interesting. I thought there was a short trade between reading you and talking to Nitti and seeing the way I was a couple days early, but I'm not a good trader at that level. But it was fun to try something. Now you had this immediate 10% pullback, which took a lot of fluff out. So it should be interesting. I mean, where's your head at? Go ahead.
Well, so the other thing I just want to say about, obviously we don't know whether it's more like 95 or 2000. Everyone has their own views. But what I think gets lost in, let's just say this is 2000, and we just put in the high for the Nasdaq. This is what gets lost, and people don't talk about enough. From March of 2000, if you bought the cap-weighted S&P 500, you lost 25% over the next year. If you bought the equal weight S&P 500, you made 25% over the next year. In other words, the exact same index, just weighted differently, had a 50% spread in returns over the next 12 months.
What carried the index the next 12 months? What carried the index?
So there were 4 sectors that from March of 2000 to the end of 2000, 4 sectors were up 40% on the year. 40% from
energy.
There was staples, utilities, financials, and healthcare.
Interesting. Okay, so you're saying there's a huge difference at some inflection points of the equal weighted versus cap weighted.
And the crazy thing is, it's way more lopsided right now than it was in 2000. At the peak in 2000, the top 6 stocks in the Nasdaq 100 represented 34% of the index.
Did not
They're
know
about 51% right now. So it's way more lopsided now. So you could say that the fundamentals were way worse then, but if those 6 stocks, if the Nasdaq 100 lost 50% in 2000 with, the top 6 stocks making 34%, you can see how much of an effect the top 6 stocks could have now. Yeah. And we saw that a little over last week. I mean, Apple lost, 12% off the highs.
Right, and some of the civilian stocks that he called them were up, like SPG.
So that lends itself to the 2000 playbook where, and I'm not saying this is going to happen. I'm just saying it has to be recognized that it could happen, that you could have the Nasdaq and the S&P cap weighted down 20, 30% off the peak, and you could have the average stock or civilian stocks, reopened stocks, whatever you want to call them, could actually do pretty well. And I think that's the call that a lot of people have been making for a while. We've made it from time to time. It hasn't played out for more than a couple of days, but I think that's sad. It could happen for a little bit more than a couple of days.
So I'm talking to a lot of CEOs of public companies who are a couple billionaires, including young billionaires, and they're like, and they laugh. They go, "What else am I going to do?" And I'm like, they're not dumb people. They're not inexperienced people, and they're saying things that make me just shake my head going, that is absurd. Like, cash is an option. So it lends itself to that idea that an equal weighted, so what's the ticker for an equal weighted S&P?
The ETF, they would be the equivalent to the SPY is RSP. So that gives you, an equal weight, but, that's not where the trend is, right? You talk, so what I look, I'm a technical analyst. I look at relative strength and trends, but then there's also a time when mean reversion comes into play, and you have to kind of weigh the two, right? I mean, if you're just strictly a momentum trend person, you would never look at equal weight right now because it's underperforming.
I honestly haven't.
Right.
I didn't even know.
But if you look at some of these historical charts, we're at such extremes that if your time frame is a little more than the next couple of days, then maybe it makes sense to kind of shift some money around.
Okay, that's very cool. This is kind of the idea of having this hangout with you boys occasionally, is just to talk. My audience loves this stuff. I keep saying no one wants it, and then every time I post like a VC chat or whatever, can we have more Nitti? Can we have more traders? Can we, I just think there's just this 20 million new people flinging around, learning by doing, and they really want to learn this stuff, and they want to learn it fast, and they're never going to be a CFA. They're more likely to be, you can go to TradingView or Koifin, or you can go to TrendSpider. There's so many great charting products for free or for a few bucks a month, and there's so many social networks to learn this on. I know you use Twitter, that's your kind of go-to, but you're not really on Twitter that often. You more are eavesdropping than sharing. Nitti, you're definitely in the background. You're kind of into the video idea of it because you're good looking and you have tech, but you're not you're a lurker more than a contributor.
Yeah, I mean, I keep an eye on everything. I mean, dude, yeah, the Reddit, the Wall Street bets of these guys, that guys. I mean, it's just, you need to have somewhat of a pulse on kind of what information's being thrown around because, you'll look at it and you'll be asking, a lot of stuff that we do is we're constantly probing and trying to figure out why stocks are moving a certain way. A lot of it's news driven or whatever is going on, over the past, few weeks. A lot of it clearly has been weekly option driven. But when you're looking at this stuff, I mean, some of the stuff that I've seen, at least over the past few weeks, that's moved stocks are completely and utterly insane. I mean, and some of the chatter and banter that you're seeing on these boards in different places, just trying to gauge what the information is. It's like, you could hit up a bunch of desks and try to figure out kind of what they're seeing as well. And then you'll find the source and you'll be like, this really just moved the stock 7%. I can't even believe it.
Yeah, I try not to think like when I see the 33% above, when I see 51% of an index, I don't short stocks, but I am looking for inflection points that will make us in hindsight go, whoa. Like March, the thing that made me go, whoa, was like, what were we thinking? Like I'm in New York in February, like an idiot. Everybody's talking about it. We see the Wuhan getting built. And then the one chart that I saw was the airport traffic from China. Once I saw that, I'm like, nothing surprising. Once you saw it, like traffic, that chart that I remember posting the chart. I'm like, why am I long stocks? Like this is gonna, that was the only chart I needed to see to just like, whoa, we're in trouble. And the only chart that made me shake my head, and it wasn't one price chart, it was the 33% above the 200-day moving average.
Well, and here's another one. So, we were 33% even. Okay, so now that was at the peak, right? A couple of days ago. Now we're at 24%.
Wow, that was a big
even with the drop we've had, 24% would be the biggest spread since 2000. So, outside of the last couple of months, we're still at a historical extreme outside of the last couple of years of the tech bubble. So, you got to weigh was it crazy? Is it crazy now compared to the tech bubble? No, but compared to every other data point in the last 35 years, it's pretty crazy. And that doesn't mean we have to crash, but if you're thinking about, what's the best risk reward over, next X amount of time frame, maybe it's not buying the Qs here.
Yeah, no, because I've been QQQ over the SPY and I'm like, not saying that for the last 2 weeks. I'm just saying, I've been a net seller for a month or two. Too early, I would say, but I'm not trying to nickel and dime my way to the top. Don, what you have to do this every day, Don. So what is your leaning right now?
I mean, the one thing that you kind of saw going into the first week September, the first 2 days didn't matter, but the week prior, I think Krinsky can chime in on this also, was the amount of protection that was being put up in very large bets the VIX. I mean, for 2 days straight, the last time the VIX and the Nasdaq were essentially both green for 3 days consecutively. Krinsky, it was a date. It was like March. It was of the peak of the last day of the .com bubble.
There are a lot of similarities. Yeah.
There was a ton, and we saw the VIX green, and you saw the Nasdaq green, and kind of started you started to think a little bit, and then you saw the protection that was being put up, and all of these September monthly options and the Qs that people were putting on a lot of protection, and right now I think the problem with a lot of people that in this tape is that the moves that happen, it's not it's not down 1%, down 1%. It's, you need to take the pain train to get positioned on the short side because the moves are so fierce to the downside. I mean, you saw it. It was, on Wednesday, we came in, market rallied. Thursday, puke day. And then Friday morning, everyone, Tesla was trading, 380 something pre-market, rallied all the way back on the close, and then they puked them, and then we had the rally into the end of the day post kind of 10:30 in the morning. So, I think right now, what are you saying?
I was just going to say, to show how crazy it is, Apple on Tuesday had an 8% drop in the first 30 minutes, and then on Friday rallied 10% from the lows to the
I did have a check,
afternoon.
I didn't notice the rally. So, but that's a $200 billion rally.
It's by far the biggest company in the world.
So that would be Krinsky, and I'll end it, and then I'll get more organized so we can do like something with charts, because this is great. I know you guys are busy, so I'm gonna end it. But that lends me to believe, if this environment, and it's hard because 200 billion is more than most fucking stock markets, right? So if this money doesn't leave the market, there could be some humongous moves into the cyclicals, and you know, if that money just rotates from the FANG stocks,
four members of the $1 trillion market cap club are down 8% since Wednesday's close. So collectively, they lost about $650 billion in market cap since Wednesday. And then Tesla, I mean, you know, market cap fell 48 billion over 2 days, which is nuts. And like, I don't know if you saw Tesla after the close on Friday, everyone thought it was getting added to the S&P, but it was Etsy and Teradyne. So it puked, you know, after hours. And I think the next date for that to happen is September 21st. But it's crazy. I mean, the amount of money that could be shifted into these other sectors, it's just...
That's what I'm worried about. That's why I won't short the indexes, because the amount of money that, if it stays in the market, it'll be hard to make money on shorts. You have to be a great stock picker to kind of get the market. So
and the small caps you mentioned, I mean, Apple is essentially has the same market cap of the entire Russell 2000, and the Russell 2000 has gone sideways for 2.5 years. So again, you know, the bears will say, well, it's, you know, it can't do anything, so it's, you know, it's awful and it's going to lead to the downside. And then the bull case is, well, you know, it's gone sideways for 2.5 years. Maybe that's where the next rotation is, and it's setting up for a, you know, breakout to the upside. So it's TBD on that, but you know, that's your point. That's the bullish rotation argument.
all right, gentlemen, this is a treat. I appreciate it. I'm going to do some testing around. I'm not going to edit this one. I'm going to test it with our audience, see if they enjoy this, but we could do some fun stuff with this. And since we're locked in for maybe another year, this would be fun. You could turn a celebrity out of it. Nitti's an instant celebrity. He'll have like, I could see him like a Taylor Swift of trading a little bit.
I could see that.
Krinsky and I will just get guy fans. Like, Nitti will get some.
That'd be great.
Krinsky and I will get, the average fan of ours about 270 and about 8 years old.
Take what we can get, right?
We'll take away. I mean, it's just a weighted average. We skew high weight. We skew high weight, older, heavy moles, and lower income. A lot of lucky. Whereas, you know, Nitti's a player. All right, gentlemen.
All right.
Pretty amazing. Of all the things, I think Zoom is the most amazing story. And I think that there won't be more Zooms in a world where we're all disconnected is the bet that I wouldn't make. Like, what makes
read
me
the
so
Barron's
excited
tonight.
What were you going to say?
Did you see it? Barron's came out bearish on Zoom. I'll send you an email. There's an article out tonight.
You can only be bearish on the valuation. You can't be bearish on a company that since 2011 has executed, and they have major, you know, tailwinds about how the world works.
I agree.
You know, it's that Barron's hasn't had a good call in a long time. I mean, it's easy to throw out a cover story, but it's amazing what Zoom, because, you know, we tried to hang out here a minute ago. You were kind of bummed about Zoom, and I was like, no, we got to go back to Zoom, because it's just like, from recording to like getting a file the minute after, it's just the little things that they're doing that makes it like kind of idiot proof. And I call it an 8 to 80 stock of mine. I like, what's so ridiculous about this run? I'm like, April. I put it on my 8 to 80 list because, you know, at the Passover.
What is 8 to 80? Just
8 to 80 are like, is my major portfolio, which is just, you know, it's about 50% long right now because of the run it's had. But it's stocks that 8-year-olds and 80-year-olds, like brands that 8-year-olds use and 80-year-olds use. Meaning,
I like it.
In a sell-off, they're not going anywhere, right? Nike. I mean, I've moved out of Nike and Disney because they're not digital only. So basically, all my companies in the 8 to 80 portfolio, I'll share them with you, are digital now. And you know them all. There's no surprises in this list, but Zoom was like the youngest. I can't imagine adding a stock that's 9 years old to my 8 to 80 list. Like, just unheard of. And in April, I added it at like 120. And, what did it hit for? Something in July the other day?
Well, after the sell-off post earnings the other day, you basically got earnings for free. And it's crazy.
478.
It hit 470. I remember selling some at like that night at 405 or whatever, and I'm like an idiot. But like, the thing is, these brands, they could have 50% pullbacks and be in an uptrend, 60% pullbacks and be in an uptrend. And so they're going to stay on my list. Not that you should buy them right here, but how do you not own a brand like this that's going to be around for 50 years and go every niche? Obviously, there's going to be competition because the market's massive. But like, these type of companies are going to exist. They're more than one. I mean, there's going to be more TikToks, and there'll be more Zooms, and everybody's building on top of Zoom. So it's like it's different than 99. It's definitely different than 99.
Yeah.
All right, boys. Thanks for doing this, and I'll talk to you soon.
All right.
All right.